Let me begin by saying that November is Long-Term Care Awareness Month. I think they picked November because Thanksgiving was the time when families everywhere used to come together to overeat, drink, watch football, and talk about dead relatives. This year, we're supposed to try having a virtual Thanksgiving. How's that supposed to work? Which will hopefully work out at least as well as this virtual PICPA conference. Long-Term Care Awareness Month was intended to increase the likelihood that families might actually talk about planning for long-term care for mom and dad. Not a great topic for Thanksgiving dinner, but after you're finished with your virtual turkey and stuffing, perhaps you could give some thought to planning for the future for your extended family. I want to thank PICPA for inviting me to speak with you today about this important subject. I'll do my best to keep it informative and try not to put you to sleep. So let's go. During my presentation today, I want to accomplish 4 objectives. First, we need to understand the key issues related to long-term care. What is it? Where can it be received? Who can provide it? And how can it be paid for? Second, we must determine when to begin having the long-term care planning conversation. Third, we need to understand the long-term care planning process and the parties involved in it. Finally, we will discuss the benefits of insurance as a funding vehicle and what types of policies are available. I started W.R. Borton & Associates back in 2011 when I was an employee benefits broker and consultant. A close friend, a retired executive who was 17 years my senior, called me out of the blue and said, "Bill, I need your help." He really sounded desperate. It seemed his wife was pressuring him to move to one of those places, a continuing care retirement community. She had reluctantly agreed to reconsider if he obtained adequate long-term care insurance coverage. I tried to explain that I was an employee benefits broker and largely unfamiliar with long-term care insurance. "But you're the only one I trust," he said. "You gotta help me." I reluctantly agreed, and so began my journey. I did a lot of research, and what I learned was shocking. Most Americans have a huge hole in their financial and retirement plan. Without a long-term care plan, their entire retirement and legacy are at risk. The sad fact is that most people end up being a burden on someone else and die broke. I thought back to my parents. They didn't have a plan either. And when it became clear that my mother's dementia was becoming a real problem, when the dentist's office called an hour after she was supposed to be there and said she never showed up, and my father called me and said, "Your mother's missing," I said, "Dad, what do you mean missing?" She said she never got to the dentist. The problem was Mom had the only car, and so my father was stuck. I drove around trying to find places that she might have gone, and later my dad called me back and said they found her at the Morristown Mall. Apparently somebody saw her disoriented and frightened. They went in through her purse, found her phone number, and called my dad. I picked my dad up, drove him to the mall, dropped him off, and he went and got Mom and took her home. That was the last time my mother ever drove. My siblings and I had to spring into action. My dad was 81, Mom was 78. Getting him to go along was the first challenge. Then compiling financial and medical records, selling and emptying out the family home of 44 years, and finally getting my mother to cooperate was daunting. Fortunately, we were able to get them into a continuing care retirement community. Thank God she was having a good day when she had her cognitive interview. We all breathed a huge sigh of relief when the dust settled. 5 years later, Mom died from complications of advanced dementia. 10 years later, my father, who had also lost his marbles by that time, ran out of money and ended up on Medicaid. Fortunately, the CCRC was required to keep him and care for him until the end. I was never so relieved that we were able to create a plan and put it in place just in the nick of time. I can only imagine how our lives would have been disrupted had we not succeeded. Now, back to my friend. My research also led me to a newer kind of long-term care insurance policy that met my friend's needs and satisfied his wife. It was being marketed at that time as asset-based long-term care insurance. He could pay for 2 policies with one really large check and be done with it. He was forever grateful. What he didn't know until later was his phone call had led me to start my own business. I now spend my days helping baby boomers with long-term care planning and insurance, hence the name of my talk today. So what is long-term care? To understand what it is, let's talk about what it isn't. It's not about nursing homes and insurance, which is what many people think of. It's not about medical care. It's about assistance with the activities of everyday living. They are dressing, feeding, bathing, toileting, transferring, and continence. Typically, as most people age, they become frail or cognitively impaired. All too often, these conditions require custodial care, also known as long-term care. What are the chances of someone needing long-term care? Mark Twain once said, "There are lies, there are damn lies, and then there are statistics." We all know we can come up with statistics to prove just about anything. Nevertheless, I'll share just a few. 52% of people over age 65 will require long-term care services and supports at some point in their lives. 68% of Americans over age 40 have done little or no planning for a long-term care need. And 83% of the care for older adults is provided by friends and family members, typically without any compensation. People literally have to set their lives aside to help people who never planned for this likely eventuality, and it has a devastating effect on everyone. What long-term care is really not about is statistics or risk factors. It is about consequences. The consequences to your loved ones if you need long-term care. So what are the consequences? Let's talk about the first consequence. Providing care for a chronically ill person tends to make the healthy caregivers chronically ill. Think about it. Try to imagine being 85. Go ahead, I dare you. Trying to help your spouse, the person you've lived all these years with. Try to help them getting in and out of bed, bathing, or going to the bathroom. Not a pretty sight. You have to know it can't last very long before something has to change. Sooner or later, the rest of the family starts to realize something's not going right and that mom's been covering for dad for a while. As a result, one of the family members is going to have to put his, or probably her, life aside if their parents have no plan because they're no longer safe without someone stepping in. Caregiving is rarely shared equally between siblings, and that usually creates friction, to say the least. The requirements of caregiving seldom bring siblings together. The reality is that, in fact, it frequently tears them apart, creating rifts that may never heal as long as they live. You may know of families where there have been children that never speak to each other again after situations like this. These emotional and physical consequences of caregiving are compounded in the case of second marriages. I'm sure you can use your imagination. Now, for the second consequence. Paying for care tends to disrupt any existing financial and retirement income plans. Paying for care also requires a reallocation of resources, which start with current income. It's highly likely that most successful people live on most or all of their current income. Think about it. Why would they pay taxes on more income than they currently need? Shifting current income to pay for care directly impacts one's ability to keep their other financial commitments and is, in effect, double counting it. Common sense tells you you can't spend the same dollars on care that you're already spending on other living expenses. Give some thought to that one. If your spouse now needs long-term care and you still need to live in your home the way you hopefully did up until now, with some changes obviously, you still need the same amount of income, plus now you need more. While the wealthy can pay for care, the dollars used to pay for that care will no longer be available to generate income. This may be okay for the time being, but over time, this could create a downward spiral if spending is greater than anticipated. Where could you receive long-term care, and what are the associated costs? Most long-term care is received at home, at least initially. Few people start off in a nursing home. Think about it. Unless someone has a stroke or serious accident, frailty or cognitive impairment tend to be gradual. I like to say to people, there's only two ways you can die, conveniently and inconveniently. And most people go inconveniently. It's the gradual decline brought on by living longer than your body or your mind were intended to. In the greater Philadelphia area, you can typically pay about $22 per hour for a home health aide. Genworth, a well-known long-term care insurance company, which has been going through some much publicized challenges over the last few years, suggests that home care for 44 hours a week in the Philadelphia area would currently cost over $50,000 a year. If you needed 24/7 care at home, and you could afford it, the cost of care could easily exceed that of a nursing home. Assisted living facilities like the Sunrise or the Brightview in your town typically cost over $58,000 a year. Memory care costs even more than that, possibly even another $5,000 or $10,000 a year. And a private room in a nice nursing home, there's an oxymoron for you, could run almost $130,000 a year. It's mind-boggling. What about the impact of inflation? With inflation averaging just 3%, a 55-year-old man at age 80 would find the home health aide now costs $117,000 a year for that 44-hour week. Accordingly, 24/7 home care may be even more difficult to afford, and the assisted living facility would cost more than $122,000 a year. That same private room in that nice nursing home now becomes over $250,000 a year. Mind-boggling. Who's going to have that kind of money available later in life? Not many people. Let's take a look at how we can pay for long-term care. Commercial health insurance, like the plan we may have through our employer or the Affordable Care Act, won't pay, not a dime. Medicare will help pay for a short stay in a skilled nursing facility under certain circumstances, but otherwise you're out of luck. And in actuality, unless you've been an inpatient for 3 consecutive days and are discharged from a hospital to a rehab facility needing skilled care, they're not going to pay anything. Medicaid will pay, but you must be impoverished, which is certainly not something to aspire to. I'm sure you know of someone who's been down this road. Think about elder law attorneys. Think about all the financials you've got to pull together. Think about all the ways that you've got to spend down assets and try to preserve the home and the family car for mom because dad needs to go into a Medicaid home. Not fun, not a pretty sight. You can self-fund, but how will you be able to generate enough income while still meeting your other obligations? For many people, that's simply not possible. Insurance may be an option if you are insurable and have sufficient non-qualified funds to pay for it. Most baby boomers have a vast majority of their invested assets and savings in IRAs, 401ks, and 403bs. Unfortunately, you need after-tax or non-qualified income to pay for insurance. And so that could involve a lot of problems where you have policies that you'd love to have but don't have a way of paying for them unless you first have to take taxable distributions from qualified plans, which really increases the cost of the insurance, something you may have a hard time justifying doing. People often ask me when they should begin the long-term care planning process. My answer is always the same. When they turn 50 and insurance is cheaper and easier to get for most people, or if later, when they are no longer paying for their children. I've had very few clients over the years, even those that are significantly high net worth, that are willing to talk about their own long-term care planning needs when they're still faced with college tuition payments. Another reason might be that they've been thinking about retirement. Perhaps they've been speaking with their financial advisor or their accountant, and they're planning ahead and thinking about things that could derail their retirement, including long-term care. Lastly, it could be in the aftermath of being a caregiver, either in their family or through a friend or neighbor, where they became aware of what the consequences could be of a long-term care event. Now, let's take a look at creating a long-term care plan. Many people do not understand that just because they purchased a long-term care insurance policy, they do not have a long-term care plan. I can recall one time really annoying somebody who started talking to me about long-term care, and he insisted that the policy that he had meant that he had a plan. I tried to explain to him that that was not the case. He got really agitated with me. I kept suggesting to him that he needs to have other things in place so that the policy ends up being the funding vehicle. And in and of itself, it's not a plan. Ultimately, he stormed off in a huff, and hopefully, eventually, the light went on between his ears, and he did something about it, at least for his family's sake. So, what are the components, and what is the process for creating a long-term care plan? First, they must have the conversation, as I call it. The conversation can involve their spouse, adult children, their financial advisor, accountant, or attorney. While having the conversation, they need to talk about their preferences. Where do they want to receive care? At home? In a continuing care retirement facility? Are they going to downsize? Are they going to go to a 55 and over community and stay at home, where they stay in the house where they raise their kids and make it handicapped accessible? You got to have a plan on where you're going to receive the care. Do they want care to be provided by a family member or a third-party service? A lot of people don't like the idea of having strangers come in their home to take care of them, and they'd like to have a friendly face. But whose face would that be, and how would they pay for that person? Do they want to be able to move to a continuing care retirement community like my parents did? Continuing care retirement communities require that you be financially, cognitively, and physically able to move in independently and under your own steam. I can recall a number of situations over the years where people were contacted by the continuing care retirement community because they put in a deposit and gotten on a waiting list. And they got the call that we have a suite or a villa ready for you. Oh, we're not ready for that yet, they said. We don't want to come in just yet. Just let the next person have it and give us a call the next time one comes up. Unfortunately, with at least 2 or 3 people that I know of, they waited too long. One of the spouses became unable to physically or cognitively enter under their own steam. Now there's a dilemma. What do they do? In one case, they took back their deposit and they and their family had to really scramble to figure out how to deal with the emerging long-term care event. In the other case, imagine this, one of the spouses moved into the continuing care retirement community and the other one ended up having to go into an assisted living facility. They were separated. I can't imagine. All because people didn't want to admit that it was finally time to move to a situation where being cared for in the near to not too distant future was possible because you wanted to eke out just another month or another year of that independent living. A long-term care plan should also include certain legal documents that are really key to the process. You must appoint a healthcare and a durable power of attorney. It's essential. The healthcare power of attorney can act on your behalf with caregivers and medical professionals in the hospital, in the rehab facility, at home, wherever. The durable power of attorney can make financial decisions, can work with the facilities, can pay and write checks for you. Without these powers of attorney in place, trying to care for you if you are physically or cognitively unable to make decisions or sign checks or speak to people could create an incredible problem for your loved ones. It would also be wise to have an advance directive or living will. A last will and testament is also important too, but in my experience, I found that chronic illness usually happens before you die, not after. Think about that. Seems obvious, doesn't it? Except I know a lot of people that have a will and have no plan for chronic illness. Next, they need to discuss funding arrangements. Are they going to self-fund? And if so, are they going to set up a dedicated account? If not, they may be at risk of having to liquidate assets to create income in a down market that may be tax qualified or even illiquid, causing investments to be sold with adverse tax consequences or maybe even at a loss. Will insurance be part of the funding arrangement? If so, can they afford it and can they qualify? For most Americans, Medicaid becomes their default funding source because they don't have a plan or haven't saved enough money. Now a written plan needs to be created. It doesn't have to involve an attorney. It could even be written on the back of a napkin. But as it has to describe what I call the who, who's going to provide care, the what, what's that care going to look like, and the where is the care going to be received, and of course, the funding for what it is that they want to have. Lastly, they need to communicate the plan. Share it with their family and their advisors, and best of all, make sure that they all A, understand it, and B, agree to it. Having the conversation, what matters most? In my experience, the most difficult part of the entire planning process is the first part, what I call the conversation. This is where you, as a trusted advisor, can help your client determine what matters most to them personally, what matters in their relationships with family members and people in their life, and what matters most in their financial and retirement plan. You can be a conversation catalyst, an integral part in the planning process if you understand how the process works. Depending on the level of relationship that you have with your client, you may be able to add real value by initiating the conversation with them. I'm frequently asked, should I self-fund? Do I have enough money? My answer is always, that depends. While self-funding may be a viable option, you need to determine if you have enough money to convert the income needed and still be able to meet your other obligations. I have repeatedly talked to people who, when the subject of long-term care insurance came up, because perhaps they asked me at a networking event what I do, or I was introduced to them, they knew they didn't want to talk to me. And so their knee-jerk reaction would be, oh, I'm going to self-insure. I calmly, if they haven't turned on a heel and walked away at that point, say, actually, I think you mean self-fund because you're not an insurance company. If they're still with me, I will explain to them some of the things that are involved. But most of the time, when somebody says that, what it really means is, I don't want to have the conversation and I sure don't want to buy insurance. I feel sorry for their family if they don't have some type of an awakening at some point and take the bull by the horns and get into the planning process. So back to self-funding. If you're going to do it, you need to double check your assumptions regarding what the current and future costs of care will be in whatever case that you've decided you want to receive care. And just in case where you want to receive care ends up not being viable, you might want to overestimate your needs a bit. It's best to look at income and not just net worth. I know a lot of people that don't seem to understand that assets pay for care, not income. You pay with income. You have to convert assets to income. You need to determine how much income will be needed, keeping in mind inflation and again where you plan to receive care. Next, you need to consider creating a dedicated funding source, which will reduce uncertainty and still not restrict your other assets. A plan for funding long-term care is important because without a plan, self-funding is your default option. This is actually, again, what most Americans are doing because they haven't planned and they don't want to have the conversation. So why insurance? I don't know too many people that like insurance or insurance companies, myself included, and certainly nobody likes to pay for it. But what I've learned over and over again over 37 years is that people really like what insurance does when it's needed. So why would you buy insurance to fund a long-term care risk? Reasonable question. First of all, it's a way of protecting your wealth, your legacy, and your ability to generate income. Remember, it's income, not assets, that pay for care. It's also a way to avoid the opportunity costs that result from liquidating assets to pay for care. Insurance allows for instant liquidity, which reduces or eliminates many concerns at a time when you may have some challenges accessing other funds. Think about it. You've got a policy, and there's three parties that are involved to that claim. You, or your personal representative, your attending physician, and a registered nurse who's working as the claims analyst for your insurance company. Insurance companies administer claims per the terms of the contract. Contrary to popular belief, They're not trying to get out of a claim or stick it to anybody, no matter what you may have heard. When you are filing a claim, typically, if you do your part right, or your personal representative, and your attending physician supports the fact that you're chronically ill, which means that there's at least 2 or more of those activities of daily living that you can't do without help, or that you're losing your marbles and have severe cognitive impairment, then getting the claim approved should go pretty quickly, pretty smoothly. And then if you have a policy that doesn't have a long waiting period, money can start flowing pretty quickly. Another thing about insurance is it can allow for a higher level of care, because without insurance, people tend to be reluctant to write those big checks to pay for care. With insurance, no one complains about receiving all the care that can be provided. Bring it on. It's like winning the lottery. Now, give it to me. Give me everything I got coming to me. You also avoid being a burden to your family. Without insurance, family members often must provide the care instead of supervising. I sometimes ask a client who's resistant to buying insurance, usually the husband, do you really want your daughter-in-law or your granddaughter changing your diaper? That usually does the trick. As I said before, when there's no insurance, someone is going to have to write checks, and as we previously learned, those checks may end up being quite large. Maybe not as large as this one, but you get the point. I'm sure you have heard adult children, possibly at that Thanksgiving dinner table, tell mom and dad, "Mom, Dad, we don't want your money. We just want you to be happy and enjoy your golden years." Fast forward to when your adult children are a little bit older and they now have kids that are ready to go to college, and mom and dad need expensive care at around that same time. Suddenly, mom and dad's money becomes a whole lot more important, and the kids, even if they have power of attorney, don't want to write those big checks for care. So oftentimes, mom and dad don't necessarily get as much care as is needed. I know one independently owned home health care agency, been around a long time in South Jersey. And when I had lunch with the owner, he told me one of my biggest challenges is when my clients don't have long-term care insurance and their children are always trying to minimize the amount of care mom or dad gets. And he said, it breaks my heart sometimes to see how little care mom and dad get and how much they are at risk as a result. So, what kinds of insurance pay for long-term care? There are several kinds. Traditional or standalone policies have been around the longest and are pure insurance. They're like auto insurance or homeowners insurance. They only pay when there's a loss. They provide the most leverage if you need care, but otherwise, no benefits are paid. That's why people say use it or lose it when they think about these policies. And for some reason, maybe because the premiums add up over time to be a lot of money, people are really reluctant to pay for something they hope and believe they may never need. Benefits in almost all cases with traditional policies are reimbursement for qualified long-term care expenses. That means these policies won't pay your daughter or your granddaughter to provide care. They'll only pay people that are licensed, qualified caregivers as part of a qualified, approved caregiving plan. Premiums are generally payable for your lifetime and may increase. We've all heard stories about older policies that were inadequately priced in the first place, and thanks to low interest rates and higher than expected claims, their price increases have gotten a lot of negative attention and in some cases created real hardships for people that bought them. These policies, traditional policies, may also allow for shared benefits between spouses, which means that each spouse can therefore purchase a smaller policy. And with these policies, inflation protection is also available, which is really essential if you're buying it when you're still less than 65 or 70 years of age. Another type of policy is referred to as a hybrid. Typically, one of the universal life insurance policies of some type, guaranteed UL, indexed UL, or current assumption UL. They have a rider that permits acceleration of the death benefit in the event of chronic illness. Remember that 2 or more activities of daily living or cognitive impairment. The riders are either based on 7702B of the code, and they're a true LTC or long-term care rider, or 101G of the internal code, and they're called chronic illness riders. It's really important to know the difference. The 7702B riders are underwritten, require a premium, and benefits reimburse qualified long-term care services. 101G riders are more tricky. Some require underwriting and a premium, and some don't. Some require the chronic illness to be deemed permanent in nature, and some don't. All pay a cash indemnity that is income tax-free. No inflation protection is available by grossing up the death benefit at the time of issue, and you can effectively back into anticipated future inflation. What I mean by that is, say you have a $500,000 policy and you're going to receive $10,000 a month from it. Well, maybe you need $20,000 a month in 25 years because of inflation. You could buy $1 million policy now, and in 20 years, that would be the equivalent of the amount of benefit that you would need today. I hope I made that clear. These policies are attractive because they pay cash instead of reimbursement, so you can pay for that informal caregiving by a family member, which you can't do with a reimbursement policy. There happen to be, incidentally, 4 carriers that I'm aware of that sell universal life policies with 101G riders that don't require permanence, do require a premium and underwriting. And so if you are particularly a man, a husband, and you have any need for life insurance, and you're reluctant to buy traditional long-term care insurance, remember, use it or lose it, or the lifetime premiums, or the rates that can go up, this type of policy could be a good bet for you because it can pay quite a bit of death benefit while you need long-term care. And if you die after a year, year and a half, your spouse will receive the balance of the death benefit tax-free, which can help her with continuing income or with her own long-term care funding. A third type of insurance, known as life-linked or linked benefit policies, these are those asset-based policies like my friend, remember back in the beginning of my talk, bought, are frequently marketed as the better alternative to self-funding because they're typically paid for by a large single premium. Underwriting tends to be easier, typically with a telephone interview and a prescription drug check, and they are fully guaranteed. The death benefit if you die without needing care, the long-term care benefit if you die inconveniently. Some have a refund of premium option, and the premiums and the benefits can never be changed. Most of these policies pay a reimbursement benefit for qualified care, but there are at least 2 that pay a cash indemnity benefit, which enables you to pay for informal caregiving, which I find most people that can afford these policies prefer. They want to get paid, they want to use the money the way they want to. If you think about it, if you're still at home and you need help, you need somebody to clean your home, possibly mow your lawn, shop for groceries, cook for you. Traditional long-term care or reimbursement policies of any kind won't provide for any of those services. But if you have one of these cash indemnity policies and you qualify and trigger those benefits, the money just gets direct deposited directly into your account and you can spend it any way you want. And with these policies, all you need to do to keep the money coming is to just have your attending physician certify once a year that you're still chronically ill. As I said, they tend to be funded with either a large single premium or perhaps 5 to 10 annual premiums, after which they are fully paid. Lastly, for people who are uninsurable, less insurable, or just too old to buy insurance because they waited too long, there are several types of deferred annuities that provide some leverage. They may still be preferable to self-funding because they pay a tax-free cash indemnity benefit even if they were originally a tax-qualified annuity. Think about that. And you can get inflation protection. So don't discount these annuities in case you have older clients. I actually have an elder law and estate planning attorney who refers me a client now and again, and they're generally at least 70 years of age, usually not in the best of health. Several of them were very, very happy to find out that they could get this type of an annuity to help pay for care. One thing over these last 9 to 10 years that I have discovered is there is no perfect policy. You tell me when you're going to need care, if at all, under what circumstances, for how long, I can tell you which one to buy. But otherwise, it's not so easy. You really, really just have to kind of try and figure it out. And that requires working with a long-term care specialist who works with all the different insurance companies and truly understands how all of these different policies work and is willing to take the time to really go through all of this with you and pre-underwrite by getting health histories. I get health histories from everyone that I work with because I don't like surprises. I need to make sure that they'll be able to qualify for what it is I think is appropriate for them and at what rate. What ways are there to fund insurance? You can pay premiums from current income, but if you're buying insurance that's going to require lifetime premiums, you need to plan for funding those premiums as a part of your retirement income plan. You could transfer money from CDs, treasuries, or other bonds that are paying low interest. In this way, that lazy money can be put to better use. Another way is through what are called Section 1035 tax-free exchanges from existing life insurance or annuity policies. They can also be used to fund hybrid or linked benefit policies. Another way is required minimum distributions from an IRA. When the distribution is more income than is currently needed, it can be earmarked to help pay premiums. You may also have an obsolete life insurance trust where the trust can be terminated and the policy rolled out. This is a complicated process. I've actually done this twice over my career. Once was a second to die policy, the other was a single policy where they had been purchased to fund the federal tax liability, state tax liability. With the increased exemption, they believed they no longer needed the policies, didn't want to pay for them anymore, and there they are sitting there in these trusts with a lot of cash in them. They wanted to buy long-term care insurance. In both cases, we were able to go through this process by terminating the policies, finding new policies, and doing those 1035 tax-free exchanges into the new policies. Of course, you can always try a combination of all of the above to fund these policies. I've had two situations over my career where a couple or an individual had bought life insurance inside of a life insurance trust, an irrevocable trust, where the intention was they would use the insurance to pay the federal estate tax liability. Given the changes in the estate tax laws and the much higher exemption, they believed that they no longer needed the trust in the policy and frankly didn't want to pay any more premiums. Those policies had a lot of cash in them. We were able to terminate the trusts and roll the policies out. In one case, with a couple, there's one company that has a policy that covers 2 lives. It's a second to die policy. We were able to roll the cash into that policy and cover a good chunk of that policy's cost. In the other case, it was a single individual, a widow, and we were able to terminate that and transfer the money into a lake benefit policy that put her in good shape. Of course, there could also be a combination of all of the above. I had clients once that had a really, what I call a junk drawer of all kinds of different assets, CDs, old policies, policies that were bought for them when they were children, and it was an amazing array of places where money was tucked away that they frankly weren't paying any attention to. They really didn't want to spend a lot of money on long-term care, and so as I was going through the conversation with them, we started uncovering all these sources of funds. And once I realized all of what was available, I started adding it all up. And for him, he literally ended up writing a check for $5,000 in order to fund a very large linked benefit policy, single premium. Considering his health wasn't that great and he didn't get standard rates, he was thrilled that he was able to get out from under this liability that his wife was very concerned about with only a $5,000 check out of his account. She, on the other hand, had a policy that covered a good chunk of a preferred non-smoker healthy premium for her, and so while she had to write a slightly larger check, she was happy to do it because she was so thrilled that she wasn't going to have to provide care for her husband. LTC may stand for long-term care, but I say it also stands for love, trust, and conversations. And remember, a long-term care plan is essential for everyone's financial health and well-being. Thanks again for having me, and thank you for your time and attention. I hope you all have a great Thanksgiving, virtual or otherwise.